Good morning. Today we are going to get into Chapter 5. Before we go into Chapter 5, though, we're going to talk about a few administrative things. First of all, what's due this week. The lag is even longer today than... Yeah. There we go. Okay. So what's due this week? We have Attendance Quiz 12 that covers today and Thursday. We have Chapter 5 homework in My Accounting Lab, and then we have the video quiz 13 over Chapter 6 in Blackboard videos. Now, I'm going to talk about the exam to start off with because I have some information. First of all, yesterday I added a 4-point curve to exam scores. So that was added yesterday morning. So if you look at your My Accounting Lab score, you will see those 4 points added to it. You'll know I added it. There'll be a little asterisk next to your score, which means that score has been adjusted. The overall score, your overall score in My Accounting Lab, if you click on results and then click on overall score, that is your grade to date in the class. And then I also want to remind you that when it's all said and done at the end of the semester, your homework and quizzes count for the equivalent of 2 exams. So it's pretty important to do as well as you can. If you think about that, if you can get your average on the homework and quizzes very close to 100, then that gives you the equivalent of 200-point exams. So that really helps your score out. Typically exams are the lowest part of the grade. So do make sure you're doing the homework and quizzes. So then I wanted to talk a little bit about the exam, about the performance on the exam. First of all, I have a URL coming up that will give you the list of scores. So it's just a list of scores sorted from highest down to lowest. You can see where you rank on that score. On the sheet, this is a PDF document, so you can download it and then look, and I've got all the exam scores on there. I think there are 560 exams taken. The average on the exam, was 70.9. The median, meaning half the people scored above 72.2, and the range of scores on the exam ranged from 28.2% up to 102%. Again, I would say that if you didn't do as well as you wanted to on the exam, there's lots of opportunity remaining in the class. We have exams 2 and 3. You also have your homework and quiz averages that count as 2 exams. And I want to talk about what I saw as characteristics of the people who did well. Now, what I did is I looked at study plan, and for the students who did study plan and completed the material and got at least half credit on everything, so actually worked through the material as opposed to just open study plan and didn't work through the material. But students that worked through the material completed every chapter and they got at least 50% on everything. The average of those students on the exam was 86%. Compared to the average, was around 70% on everyone else. Then if I bumped it up and if I looked for the students who got at least 75% correct on everything in study plan, the average for that group went to, almost 92%. So the students who opened study plan and worked through at least, okay, that's me, hold on. Just a minute, right now what you're seeing is nothing. I am fixing that, hold on. We should be good now, right? Well, let me just look. Okay, great. Grades are in study plan under results. not in my accounting lab under results. Okay, so what we're saying here is the student who worked through and earned at least 75% on all the study plan content, that group had 92% average on the exam. So you could see a really, really high correlation on the scores and the use of study plan. Now, just looking at the difference in scores, so then I said, okay, let's just look at students that opened study plan ever versus those who did not open study plan. It wasn't a huge difference, but it is statistically significant. Of the people that opened study plan, that average was 72%. Everyone else who never touched study plan, 65%. Now that doesn't say that if you open study plan you will magically increase your score by 7 points, but it does show you that there is a big difference between these groups. Then I looked at the attendance quiz. The attendance quiz, did you come to class? It's the closest proxy I have. If I could take attendance in class, this would even be stronger correlation. But let's just go with, I looked at the group of people who had attendance quiz scores average of 100%. Okay, so these students were either came to class every day or did go back and look up the questions, had 100% average. The average on the exam, 77% versus 68% for everyone else. So there's a pretty big, to me, the things that you can do to improve your performance is come to class every day. And by come to class either in front of me or online, attending live is usually the best because then you can ask questions if you have questions. But certainly to go through class, to spend the time on the attendance quizzes to get the 100% because again, your quizzes and your homeworks together count as 2 exam scores. And then I have one more that shows you the average number of hours spent in study plan by exam grade. So what you've got here, the first green bar, the far left bar, those students that scored 90 to 100 or 90 to 102% actually, spent on average 5.2 hours in the study plan. The B group, 80 to 89, spent 4.5 hours. The C group spent about 3 hours, and then the average was a little bit lower for anybody that got less than 70. Now, I saw a wide range of time spent in study plan. I saw someone that had 18 hours in study plan but didn't complete a single problem, which just tells me just opening study plan and leaving it open, you can't get the stuff by osmosis. You do need to work through it. So, but you saw that working through the problems. In the next exam, your problems, the exercises on the next exam, again, are coming from study plan, which comes from homework. And a lot, I'd say a fair number of the multiple choice on this next exam come directly from study plan as well. Now, I sent out an announcement about how to see your exam. We have hours this week to come and see your exam. You don't need to make an appointment. You come during these hours. These hours that I'm posting here were in announcements in Blackboard, so you can, it's not new. Brian will go over your exam with you. The appointments take 5 to 10 minutes. The exams in here are not cumulative in that you're not going to see these questions again on the exam. That said, the basic concepts of debits and credits and journal entries, we're going to use that the entire semester, but the actual questions you will not see. He's in room 579 in the College of Business on the 5th floor. That's the Beta Alpha Psi office. And he'll be there today from 1 to 2, Wednesday 2 to 5, and Thursday 1 to 2. I want you in this week to see the exam because it's more recent. If you wait any longer, it kind of fades. And Brian doesn't typically have these hours available. So he typically doesn't work these hours. So this is why if you want to see your exam, your opportunity is this week. And so that's that. Okay, now once you've seen your exam, then you want to talk about it, come see me after that. So the process is you see Brian and then you come see me. I have office hours and I have office hours before the morning class, so 8 to 9 and 12:30 to 2. So we can talk about it, but the first step is to see what you did wrong. What kind of problems did you get wrong? Did you get the exercises wrong or the multiple choice wrong? And maybe what you did is right on. You just need to do a little more of it. So our next exam is coming up soon before we know it. There's going to be a lot of exams going on the next week because the next exam is the week before the drop date. And there's going to, as faculty, you want to be sure to get as much information to students about their performance before that drop date so you can make an informed decision. So that said, that's why our next exam is in 3 weeks, because it happens the week before the drop date. So the exam is Tuesday through Thursday, March 18th through 20th. If you're in sections 5 and 6, you can schedule with ProctorU right now for that week. It will work just like the last exam, and the drop date is that Sunday following this week. So whatever, Sunday the 23rd or something like that, whatever that Sunday is. But that's the drop date, and that's why the exam is where it is. So this next exam will cover chapters 5, 6, and 7. It's only 3 chapters, which is nice on one hand, but on the other hand, it tends to be pretty challenging. So if it were me, I would start preparing for this next exam now by going into study plan and working through chapter 5. Okay, so questions? Each exam is roughly the same. I'll put out another exam document, and they're roughly the same. I won't guarantee it's got exactly the same number of questions, but it will be very similar. I'm not going to change up significantly. So the question was, does the next exam have the same number of multiple choice and exercises? Roughly the same, yeah. Chapters 5, 6, and 7 are on this next exam. And again, study plan, you have to go office hours to view the exams. You cannot view the exam on your own. Okay, and those hours are this week. And there is, if you want to see the hours again, there is an announcement in Blackboard you can click on, and I posted those. Okay, closely related to exams is we have tutoring. We have not yet filled up tutoring, so I would encourage you, if you need extra assistance, to come to tutoring. Haley has tutoring every week, and the sign up is under announcements in Blackboard. You just click on the link and sign up. We have tutoring Tuesdays, Wednesdays, and Thursdays. So on to Chapter 5. Okay, Chapter 5 is about short-term investments and receivables. So what we're doing is, we talked about cash a while ago. We did the bank reconciliation. We talked about cash being our most liquid asset on the balance sheet. The next item down in the balance sheet are going to be accounts receivable and short-term investments. So these are things that are almost cash, but not quite. So we're going to, in this chapter, start with a question. This relates to the video and the reading for today. So the first question is coming up. Okay. Short-term investments may be divided into held-to-maturity securities, trading securities, and available-for-sale securities. True or false? So what do you think? True? True? I wasn't talking for a minute or two. I was waiting for people to write this down. I did get answers now. Got a bunch of truths, and it definitely is true. There are 3 categories of short-term investments: held to maturity trading securities and available for sale securities. One more question relating to the videos, and then we're going to do, we're going to do 2 more questions, and then we'll do a homework problem. So this next question is true or false, and it deals with an unrealized gain. An unrealized gain occurs when a company sells a trading security. True or false? You guys didn't, I just didn't talk for a couple minutes while I was waiting for people to write down. What do you think? False. Okay. You look warm. I'm being. I'm in the warm. Oh, yeah. Okay. On this one, I got an answer of false. What to do? A lot of falses. Okay. And this is false because whenever you see the word unrealized, so this is important. When you see the word unrealized, that is a trigger instantly that unrealized means it hasn't been sold, that we still have it. We have to have a way to signify to investors that we haven't actually sold the security, we're just comparing the security to its market value. So whenever you see the word unrealized, that does not go with sold. Unrealized means we're still holding it. I would star that because whenever you see, these are easy points. When you see a question that has the word unrealized in it, that's a very specific accounting term, and it simply means we have not sold that security yet, that this is market value. If you see just the word gain or just the word loss without the word unrealized, that means this has come from something that we've actually sold. When you see unrealized, it means we're comparing what we paid for the investment to the market value at the balance sheet date. One more true-false, then we'll go to a homework problem. A company will have an unrealized loss if the fair value of the investment is greater than its cost. True or false? What do you think? True? False? Okay. What do you think? False? Okay. What do you think? False? What do you have, Brian? About split? Okay. More false than true? Okay. This is false. And the reason it's false is because we're looking at the fair value of the investment versus its cost. Think about if you paid $100 and the fair value is $150, you have an unrealized gain, not a loss. So an unrealized loss occurs if the fair value is less than cost. Yes? If it's unrealized, it's what? Right, and you're absolutely right. Unrealized means it hasn't been sold yet. But unrealized, so what? It's not saying we sold it. This is unrealized is when we're holding a security, and in this case, the fair value of the security. So we look up the stock quote in the Wall Street Journal, and maybe it's selling for higher than what we paid for it. We're going to have an unrealized gain. So unrealized means you're absolutely right. We haven't sold it. We're holding it. But because we can look up the value of securities, we value them at market value if they're in this trading securities catalog. Yeah, no. And you would be right in your situation, but yeah. Unrealized means we're comparing the fair value to the cost. So because remember, trading securities have a market value that we can look up and it's easy to verify. So this would be true if it was unrealized gain. Okay, next up, homework problem, exercise 521A, part 1. Okay. In this problem, we have Eastern Corporation. They buy 1,000 shares of stock at $57 a share. So they hold this Dream Incorporated stock at $57 a share. They assume that Eastern expects to hold the Dream stock for 1 month and then sell it. The purchase occurs on December 15, 2012, and it gives us the market price of a share of Dream stock is $58 per share. First question, what type of investment is this to Eastern? Give the reason for your answer. If you're having difficulty with the audio, Brian has put the phone numbers in that you can call, the phone number that you can call and get the audio. So look in the chat back just a little bit. He's got a phone number you can call and that will give you the audio. Okay, what type of investment is this to Eastern? This is a trading investment. Trading investments are those that we intend to sell the stock within a short time. Okay, next one down. Record the purchase of the Dream stock on December 15th and the adjustment to market value on December 31st. So on December 15th, to purchase this investment, we would be debiting short-term investment. Short-term investment is an asset. We bought 1,000 shares at $57 a share. So you have $57,000 as your debit, your increasing assets. You're paying for it with cash, so your cash is decreasing, so that's why we have the credit there. The second entry there, the December 31st entry, we are going to mark it up. So what we have, the situation we have for the second entry is we bought this at $57 a share. It's now currently worth $58 a share. So we're going to mark it up. We had a gain of an unrealized gain of $1. So $1 times 1,000, that's where the thousand's coming from. So we're going to increase our short-term investment by the 1,000, and we're going to increase unrealized gain on investment by the 1,000. So I'm going to pause here for a minute. I'll be quiet for about a minute, and then we'll continue in just a minute. So what we've got here on part 2, December 15th, we have the purchase of our investment. So we're going to debit our short-term investment for the cost and credit cash. Now December 31st, what's going on here is we're marking this trading security to market. We bought it for $57. It's now worth $58 on December 31st. So the day that we prepare our financial statement, we want to include that security on our balance sheet at the market value. So we had a gain of $1 a share times 1,000 shares. So we're going to increase our short-term investment for the amount of that gain. Now that's an unrealized gain because we still hold this security. We still hold the stock. So we're going to credit unrealized gain on investment. When you're making your sheet for this next exam, these are good journal entries to put on it. I would definitely put this purchase of a short-term investment. You are always going to debit short-term investment. You are always going to credit cash. Okay. Then the second entry, you are going to, for an unrealized gain, you will debit short-term investment. You will credit unrealized gain. So this is the entry if you have an unrealized gain, meaning the stock price went up after you bought it. I would also on the sheet put the entry for an unrealized loss, and you can, if we probably will see one later in our homework. If not, it is in the book. So, but this one is for an unrealized gain, and that's a good journal entry to have on your sheet. And then we move on to the third question, and the third requirement says show how Eastern would report this investment on its balance sheet at December 31st in any gain or loss. Again, I'm going to go quiet for a minute while I wait for people to write it down, and then I'll talk about it. Yes, fair value and market value are the same thing in this case, an estimated value. You might have a couple different terms, but we're saying what's the market value or the fair market value on the balance sheet date. what we have in this requirement 3, we're showing how we would report this investment on the balance sheet. So the balance sheet is arranged by liquidity. The very first item on the balance sheet is cash, and then shortly there, right after there usually, is short-term investment at market value. And it is noticed that that is shown at its market value. So you see the $58 a share times 1,000 shares. That's what we have on the balance sheet. On the income statement, this is going to be shown in a separate section called Other Revenues and Gains. Unrealized gain, again, that's a signal to an investor that we haven't actually sold it. If we had sold it, it would not have the word unrealized. We don't ever see realized gain on investment. We might see gain on investment or unrealized gain. So unrealized gain tells you we still own it, that it's an adjustment to market value. So there's that. That is actually part of the slide that I did a screenshot, and the cursor is part of that. It says balance sheet. ABC Company purchases a trading security for $12,000. The entry to record this transaction will include what? And I would refer you back to those journal entries that I just showed, that I just said that would go on my sheet preparing for the exam. So we're going to, again, I'm going to take a minute of silence, let you write this down, and then I'm going to walk around and get answers. You're going to go A? Okay. What do you think? B? Okay. B? Okay. What do you think? Okay. B. B? What do you think? No idea? Okay. Okay. Do you have, yeah. $19A's, 7 B's, and 2 C's? Okay, for this question, you should be able to answer it. Look back at your notes at the entry that we just did for buying a security. So I'm going to remove the answer choices here and say, what do we debit and what do we credit? Now, even if I didn't have my sheet in front of me and I said I bought a trading security for $12,000, what's one side of that transaction? A credit to cash, yeah. So we know we're going to credit cash. You know the other side? And we're going to debit investment, short-term investment, right? So just to shorthand this, we're going to see a debit to our investment, and we're going to see a credit to cash. And that would have been on my sheet of journal entries that I considered important. So I know this. And a lot of times I'll write the journal entry off to the side as I'm trying to answer this. So I'm going to see my debit to investment, credit to cash. It could be to short-term investment or whatever, but it is a debit to our investment account. And again, so I have that in front of me. I look back at the list of entries, and when I purchase a short-term investment, this is what I'm going to do. So, and I know the amount has to be $12,000. That's the only dollar amount given to me here. So now when I go to answer my question, so keeping this in mind, I have a debit to investment and a credit to cash. So when I look at my answer, okay, the only answer it can be going through that list is A. And the reason it's A, remember we have a debit to investment and a credit to cash. So when we look at the answers which are going to appear now, okay. Debit to investment, that was one of them. We had a debit to investment and credit to cash. So we knew it couldn't be B because we didn't credit investment, we debited investment. And then there was nothing to do with unrealized gain there. There was nothing to do with dividend revenue. So when we see this kind of question, the easiest way to answer it is look at the journal entry. Look at what you would do. And you have those, you can either reason through them or you can look back at your sheet and say, well look, I have this journal entry for a purchase of an investment. Here's what it is, and it can only be A there. Okay, our next question's coming up. The investment account is an asset. So going back to the debit credit handout in the very beginning, we look at assets and their increase with debits, and they do have a normal debit balance. So again, that debit credit handout is relevant throughout the entire chapter. Okay, this one, I'm going to give you a minute or two to read it and come up with an answer, and then we're going to talk through it. The part of the question is we're talking about an unrealized gain. I'm going to come back to this, but right now I'm going to go ahead and I'm going to give you two questions to answer this question. So there's two little questions to answer. Okay, first of all, this is to answer yourself, to answer this question. Unrealized means what, and how do we get a gain? Those are the two questions you need to ask yourself to be able to answer this question. So unrealized means what? How do we get a gain? So going back to the question, I'm going to walk around in about 30 seconds and start getting answers as soon as it comes back up here. Yeah, an answer? C? Okay. C? Okay. C? Okay. You have mostly C? Okay. So let's go back. We'll come back and see this in a minute. But going to the questions about, I told you to answer this. Unrealized means what? When we talk about unrealized, it means it's not sold yet. Okay. So immediately, upon seeing the word unrealized, that's a signal we have not sold this yet. How do we get a gain? Well, a gain or a loss comes from comparing cost to fair market. If we have a gain, that means the fair market is greater than what we paid for it. Because we're always saying, here's what we paid. Is it worth more now, which is a gain, or is it worth less now? And that's a loss. So we're always comparing cost to fair market, and unrealized means what? So with these facts in mind then, we can eliminate two of the choices immediately, okay? The first two choices, A and B, cannot possibly be the answer because it says a trading security is sold. That word sold is incompatible with the word unrealized, okay? So right then I can narrow my choices down, and I know it has to be C or D, okay? Now, the question remains then with the part that we're going to question now, the difference between C and D, is the fair value of the trading security more than its cost, or is the fair value of the trading security less than its cost? So that's the difference. So we go back to answer that question about what's a gain. A gain says that it's worth more than what we paid for it. So this answer has to be C. Now where we're heading next, we've kind of gone over some of the high points of dealing with short-term investments. Now we move on to, we're kind of entering the area of receivables. So this chapter is about investments and receivables. More of the chapter is about receivables because it's just a larger topic. So what we're going to do is we're going to go through a homework exercise that actually has a lot of really good journal entries in it, nice to put on that sheet, so on that review sheet for the exam. So we're going to do exercise 5-23A. We have a list of transactions here, so we're going to go through those. And again, now we're switching over to receivables. So this we're looking at sales discounts, sales returns, and how to account for accounts receivable. Accounts receivable is what happens when we sell goods or services to a customer and they basically give us an IOU. Again, this is the journal entries we're doing here are good example journal entries to put on your sheet. And we've got a list of transactions starting with July 2nd, and we're going to be doing the journal entries for these transactions. So starting with July 2nd, we see that we sold merchandise on account. So whenever you see the word on account, it means that it's going to be either accounts receivable or accounts payable. If we're selling it, it's our customer that owes us, so it's a receivable. So we sold merchandise on account to Aaron Bailey, $800, terms 210, net 30. 210 means that if we pay this, if Aaron pays us within 10 days, she will be able to take a 2% discount. Otherwise, she has to owe the entire bill to us within 30 days. Now, getting a 2% discount is pretty huge in terms of annual interest rate. If you get a 2% discount for 10 days, that's pretty good payment terms. And companies will offer these kind of terms to be able to speed up their cash flow. What we're going to do when we sell the merchandise on account is we're going to be debiting accounts receivable and crediting sales revenue. And we've seen this journal entry actually back in Chapter 2, I believe. So this one isn't any different. So July 2nd, when we see sell merchandise on account or sell services on account, we're going to debit accounts receivable, the asset, and we're going to credit sales revenue. And we do that for the full amount. Yes. The question is, in the future, will I tell you if they paid within the 10 days? It's going to be one of the transactions. So we don't make any assumptions about payment unless we're told they pay. So we're just right here on July 2nd, we're recording the sale. So we'll work our way down, and she actually does pay on July 12th, and we'll talk about that. Yeah. But you have to have a transaction given to you. If we have a sale on account, we will debit accounts receivable and credit sales revenue. That is the journal entry. That should be on your sheet. The next one down, July 10th. July 10th, we sold merchandise on account to O'Brien, $1,500. Same terms, 210 net 30. So what we're going to see there, exactly the same entry, just a different dollar amount. So July 2nd, July 10th are both the same when we record the initial sale. We're selling it at the original sales price, the original invoice amount. Because when they make the purchase, we don't know if they're going to pay within the 10 days or not. Now, moving down to July 12th. When we calculate our 10 days, we don't count the day of sale. So 10 days from July 2nd is July 12th. We collected payment from Aaron Bailey for July 2nd. So it's telling us that we received cash from Aaron Bailey. Now this is within her 10-day period. So what we need to do is we need to calculate the discount amount. The discount amount is 2% of the invoice. So it's going to be 2% of $800. So this is back relating to the sale on July 2nd. So 2% of $800 is $16. So Erin is going to pay $800 minus $16. So the actual cash she pays is $786, $84. Yeah, 84. I've got the entry up there, and we'll talk through it in a minute. Now I'm going to talk through this entry. So we'll talk about how we did each line of this. First of all, the thing that we had to do first on this entry is calculate the amount of the discount. The amount of the discount is the $800 times 2%. So $800 times 2% is $16. That's the discount she gets to take off her bill if she pays within 10 days. She did. So the cash that she would pay is the $800 invoice minus the $16 discount to give $784 as the amount of cash she actually pays. So cash, because we're receiving cash from Erin, we will debit cash for $784. So that's the net amount. If you pay within the discount period, if their customer pays within that discount period, they're going to pay you the original invoice amount minus the discount. So the $784. Then we have to debit sales discount for $16, and we need to credit accounts receivable for $800. If I were doing this journal entry, well, first of all, I would write this journal entry on my sheet. I would say, here is how to record a payment from customer within the discount period. This is what you're going to do. And so I would write down the debit cash, debit sales discounts, and credit accounts receivable. Okay. Now, the order that I would do that in is I would figure out my cash. I know what I'm going to debit. I'm going to debit the $784 because that's how much cash I'm getting. My next dollar amount that I would put down would be the accounts receivable of $800. Erin bought $800 worth of merchandise in the beginning. So Erin bought $800 worth of merchandise. So we said back on July 2nd that Erin owed us $800. Well, on July 12th, Erin is paying her full bill. So we need to get rid of that $800, so that's why we're crediting $800 to accounts receivable. She doesn't owe it to us anymore. So at this point we'd have the cash for a debit of $784, accounts receivable credit of $800, so then that difference, the discount is $16. Yes? The sales discount, we'll get to that in just a minute, okay? First of all, on my sheet I would have this entry written. Okay. Now, so we have cash, which is an asset, accounts receivable, which is an asset as well, and sales discount. Back to your question. Sales revenue is a revenue account. Sales discount is it's a contra revenue account, meaning it's the opposite of sales. If we record a sale, it has a normal credit balance. Sales discount has a normal debit balance, because what this is going to do is it's going to reduce our original sale. So we recorded the sale at $800, but she's taking a $16 discount, so the net sale is $784. So sales discount offsets sales. Okay, so it's known as a contra revenue. Whenever you see the word contra, it means it's backwards from the normal account. So sales discount offsets sales revenues. Because back when we sold the merchandise on July 2nd, we have no idea if she's going to pay us within that discount period or not. So we record the whole sale at $800, but then when she pays us, we need to reduce that, and we reduce it by putting it in sales discount. Okay. Now, when the question was, how do we know she paid the reduced amount? We assume she's going to pay the lower, you always assume she pays the lower amount if it's within the discount period, because people will pay within the 10 days just to get that discount. If, and to Rhonda's question, it doesn't mean if it paid off or collected payments, they mean the same thing. You just have to look, if they don't specify the dollar amount, you have to look at the dates, and if it's within the discount period, you're going with the discounted amount. Okay. Okay, so that was July 12th. So now we move down to July 15th. July 15th, Elise, the sale on July 10th person. She returned $500 of the merchandise purchased on July 10th. So now we have someone saying, I don't want this, I'm returning it. So what we need to do is we need to say two things. First of all, we have a sales return. Sales returns and allowances is a contra sales account as well, contra revenue account. And then we need to reduce the accounts receivable. So again, I'm going to go silent for a minute or two, and then I'll talk about this. Is your question about this one? Contra revenue, yeah. Gotcha. Okay, July 15th, Elise returned $500 worth of merchandise. So really what's happening is we're reducing our sales. However, we don't want to debit sales because then it just nets out. As a user of a financial statement, I would be very, very interested to see how much a company's sales returns were. If a company had a lot of sales returns, that could tell me that maybe something's wrong. Why are they getting all these sales returns? So I don't want to bury the sales returns in the sales revenue number. So that's why we have this account called Sales Returns and Allowances. Sales Returns and Allowances is a contra revenue account, and it's designed to be shown with sales. And we are going to, yes, I will show you what we're going to do with sales returns and allowances and sales discounts in the next step. But so we're going to debit sales returns and allowances, and we're credit accounts receivable. Remember, accounts receivable is the asset account. When we originally recorded the sale to Elise O'Brien back on July 10th, we debited accounts receivable for $1,500. Now we're going to take $500 out, so she no longer owes us $1,500, she owes us $1,000 because we're reducing it for the amount that she returned. This is a great journal entry to put for return. When people return things, this is what you're going to do. You're always going to debit sales returns and allowances, credit accounts receivable. Okay. Now, July 20th. Is the one that gets a little complicated. So what I'm going to do is I'm putting the journal entry up here, and then I'm going to pause for a minute or two while you write it down, and then I'm going to walk through it step by step. So I'm putting the journal entry up here. You'll see the calculations on it, but I am going to talk about it, but I'm going to wait till I see people finished writing. There we go. On July 20th, we collected payment from Elise. First thing we need to do is calculate how much payment we received. July 20th, we originally sold this merchandise on July 10th. So this is 10 days later. Remember, we don't count the date of sale. So it is 10 days later, so it is within the discount period. So we know we're going to be doing a 2% discount. Now, we sold $1,500 originally to her, but she doesn't pay for the $1,500 because she returned $500 of the merchandise. So that's how we get the $1,000. She owes us $1,000. The original $1,500 less the $500 she returned on July 15th. So she had $1,000. Our 2% discount on $1,000 is $20. 2% times $1,000. So the amount of cash we're getting from Elise O'Brien will be the $1,000 that she owes us minus the 2% discount of $20. So that's where the $980 comes from. The sales discount is going to be the what she owes us times the 2%. And then accounts receivable was that original $1,500 minus the $500 she returned. So you can keep track of the transactions. You do kind of need to do an extra step on this one, but that's what's happening July 20th. The second requirement now, so we've done all the journal entries. Those journal entries are excellent examples on your reference sheet. Those are some very basic journal entries. For requirement 2, prepare the computation of net sales for the month of July. What I'm going to do, again, I put it up here, write it down. As soon as I see people done writing, I'm going to show you where all those numbers come from. Okay, so write it down now and then we're going to walk through it, so it'll be quiet for a minute or two. That box that I have there, the sales revenue, less sales returns and allowances, sales discount, all of those numbers came from the journal entries we just did. So that box you're going to see on the next slide at the bottom. So I'm going to take that box and shrink it down. On the next slide I also have a list of all the journal entries that we just did. So what I'm going to be doing is showing you where we get all those numbers. So at the bottom here, under Requirement 2, there's that box. So where we just talked about the box, and then above that, July 2nd through the July 20th, those are the journal entries that we just went through. So our sales revenue, we go through and we're going to be, actually where we're getting sales revenue, it doesn't matter which number. We sold $800 worth of merchandise on July 2nd. We sold $1,500 on July 10th. We could look for wherever we have sales revenue. So we have $2,300 of sales. Then moving down, the next item down, we have that $500 sales return and allowance, and that's coming from July 15th. Okay, so we saw the sales returns and allowance. Then the sales discounts, moving down on that one, we had two sales discounts. We had the one for July 12th and we had the one for July 20th. So we had the $16 on July 12th. We had the $20 on July 20th for the 36th. So then our net sales revenue is going to be the $2,300 minus the $500 sales returns and allowances and minus the $36 of sales discount. So that net sales revenue is going to be, so what we're doing is we're saying how much did we really sell after the returns, after the discounts. From an accounting standpoint, sales returns and allowances, very, very different account from sales discounts. Whenever you see sales discounts, that refers to credit terms that we've given. So it's reductions that customers get for paying their bills within the discount period. That is a discount. As opposed to sales returns and allowances, that's if someone returns something to us, or let's say my son got a refrigerator, this is true, and when H.H. Gregg delivered it, they dented the front of it. And they said he had a choice at that time. He could either reject the refrigerator and have them deliver another one the following week, or they would give him a $200 back. And so he decided to put a magnet over the dent and take the $200. And it works really well. But that $200 from H.H. Gregg they're going to account for it as a sales allowance. It's a reduction in the sales price because of something that happened or whatever. For whatever reason, you're reducing what you sold. Okay, so that's a really good set of journal entries that you would need for the sales revenue and accounts receivable. So now we're going to get further into accounts receivable, and this next question relates to the videos. And this one is the allowance for uncollectible accounts. So this is the amount of bad debts we think we have for accounts receivable. Normally has a credit balance. True or false? Oh. Well. There we go. Now I do. What do you think? True? What do you think, Paige? True? True? What do you think, Brian? What's being reported? What are you reporting? True? Okay, mostly truth. Okay, this one is absolutely true, so good job. And the reason it's true is because the allowance for uncollectible accounts is called a contra asset. Contra asset means it's going to reduce the asset that it's reported with. I think that brings us to the end of what we're going to do today. I don't have anything that would fit in 4 minutes. So we're at the end of today, so we will finish up Chapter 5 on Wednesday.